investors are becoming more worried about the possibility that steep trade tariffs may soon be a reality, perhaps depressing economic growth and boosting inflation at the same time. Our first guest of the morning is a veteran Canadian portfolio manager who's advising clients to stay diversified. Let's welcome Christine Tan to the program. She's a portfolio manager at Sun Life's SLGI Asset Management. Thanks, Christine, for coming in.
Good morning. Thank you for having me.
So ever since Donald, before he was elected, when he made that famous post on Truth Social, people have been bracing. Ordinary people, workers, politicians, business people, and investors have been bracing for tariffs. He's still talking tough on tariffs. And the most recent narrative that I see in the markets when I read market analysis stories on the day's trading is that investors are becoming more worried that, that these tariffs will be in place before too long and will have a negative economic impact. What's your take on this, and what are you telling your clients?
Yeah, what we're basically telling our clients is, first of all, we don't know about the timing, we don't know about the scope of it, and we don't know what the real intentions are. But we have been cautioning clients against just assuming that tariffs are purely a negotiation tactic, that once he gets, the border issues addressed, we're magically going to be in the clear. The reason why we've been saying that is that if you listen to, as you said, Trump, even in his campaign, he's been pretty open. He talks about tariffs and tax cuts almost in the same breath. And really, in his mind, he thinks of it as kind of almost a funding mechanism. So for context, last year, the U.S. imported almost $4.1 trillion in goods, right? So the export side was about $3.2 trillion, but exports doesn't really generate direct revenues for Treasury. But when he's thinking about tariffs, he's like, well, we buy $4.1 trillion from the world. You've heard him sort of float the idea of a universal tariff. I think 10% is a number we've heard.
Right.
In some cases, we've heard 20. 10% of 4.1 trillion kind of gets you to a number that's close to what the tax cuts that he's proposing will cost, which has been estimated to be...
An across-the-board 10% tariff would be pretty negative for Canada, correct?
Absolutely.
And other trading partners of the United States.
Absolutely. And again, not to say that it's going to happen, but it's really the message is that don't just assume it's a purely negotiation ploy and that it's going to go away, because this administration is thinking of tariffs differently. And you can see that in how they chose to implement it. So in the first term, they went what I'll call the traditional route, which is using the Trade Economic Act, of implementing tariffs, which is a very lengthy process. You have to identify the good, you have to consult with industry players, and you have to actually prove that there's harm being done. And that's why in the first term, it was 2018 when he enacted his first tariffs. This time, he talked about fentanyl and illegal immigration as reasons to trigger IEEPA, which is the International Economic Emergency Powers Act. Now, what's interesting about IEEPA was when it was created or created back in 1977, it was meant for financial sanctions. So IEEPA was what President Biden used to sanction Russia, for example. It wasn't meant for tariffs, but at the same time, it did not explicitly exclude tariffs. So really, this administration is kind of going about it in a different way. But by triggering IEEPA, it allowed him to start thinking or talking about tariffs right away, as opposed to the first way, which is you have to go through this lengthy consultation process. And what that tells you, that should tell you is fundamentally, their thinking is different. So this isn't about specific classes of goods. It's about tariff holistically.
So let's circle back to your advice to clients to stay diversified. And that includes, I've read some of your commentary here and some of your notes, that includes not making heavy bets or establishing heavy positions in sectors that you believe might be somewhat immune from tariffs, correct?
Correct. And what we mean by that is, if you look at the narrative over the last 2 years, it's been Mag 7, because there's a secular theme behind it. And then we saw what happened with DeepSeek. What DeepSeek essentially did was democratize AI, and it just changed the landscape of who the potential beneficiaries were, really widened out the potential beneficiary list. And then what we mean by staying diversified is we can assume that there's certain sectors that are less exposed to tariffs, like financials, services, utilities. Theoretically, they are. So those are sectors that you can look to for a little bit of safe haven, but don't be too overly concentrated because we don't really know how things are going to play out. The other piece that we're telling clients is really, if you have been very underexposed to government bonds, this is the time to be looking at government bonds, because if there's one thing that will come out of tariffs is that, to your point, growth will slow down in Canada, but also globally. At the same time, inflation might be sort of an issue, but the impact on growth will be much greater in the short term. And so that's where government bonds, as sort of that safe haven, that protection, will play a bit of a role. So staying diversified, no big bets, and really, especially when it comes to single stocks, try to really diversify your risk.
Most Canadian investors hold some U.S. stocks. How should they be thinking about their U.S. holdings in this context?
So coming into this year, we'd identify some key investment themes, and one of them was really looking at ex-US developed markets, as we call them. So that's Europe, that's places like Japan. And we're not saying abandon US because we're still expecting good earnings growth to come out of the US. And to your point earlier, when you're talking about currencies, at least in the short term, if there are broad tariffs being implemented, US dollar will rally or should hold in better versus other currencies. But valuations are pretty extended. So, stay there, but if you've been overweight, start to look to redeploy to global markets. Like if you look year to date, for all the noise around tariffs, for all the concerns around what's happening in Russia and Ukraine and whether or not there could be a negotiated deal, Europe has actually outperformed the US. And even Canada has actually done quite well. So again, it's that diversification, looking at where there's relative value and where we have room for at least a not so bad case scenario to play out.
That's Christine Tan coming up.